So what do we like heading into the year 2020, the year of the rat? And just by the way, it's characterized the year of the rat by being flexible and open-minded to make your life easier. We're all looking for something like that, which is good to know. And where you should keep an outlook for opportunities and take advantage of the most out of them. So it's good kind of advice heading into this new year. So what do we like? 13 billion market cap company, diagnostic pathology player Sonic, which ticker is SHL, is one of our top picks, appears to be very well placed, a very good opportunity heading into this new year, really backed by defensive earnings, I'd say really attractive industry fundamentals, growing scale, and a really strong balance sheet. Now, why are we picking up the stock here around $29? It seems to want to bounce around this $30 range, give or take. Well, I think there's more upside to name why. First, it is one of the world's largest pathology companies. It's actually the third largest player, deriving 60% of its earnings offshore. That's really good because it's really diversified out of its domestic kind of highly volatile revenue base, which is good to see. The second reason is it really operates against a backdrop of continuing growth in pathology. Demand for pathology, as I've talked about ad nauseum before, is growing. Obviously, we have an aging demographic. Chronic diseases are still prevalent, unfortunately. It's really helping physicians really diagnose those diseases and point the patients in the right direction to be treated. And third, I'd say it's really about scale economies. This company, it's a very easy business model to understand. It's really growth through expansion. They both have international as well as domestic opportunities on that front, and they're sitting on more than enough capacity, over $1 billion on its balance sheet, readily available to do further acquisitions, and you can expect those to come up. And last, I'll look at the profit. It's actually growing. Nice to see that it can contain its profit growth going out. We are forecasting high single-digit growth for the next 3 years, which is good to see. The relative valuation on the forward multiple is 1.3. Now that's slightly above its longer-term average of 1.27, but I'm not too worried about that. All these names seem to be a little bit elevated, but Sonic of the group is not as high as namely the others, namely CSL or Cochlear. And it is also throwing up a 3% dividend yield at the current valuation, which is nice icing on the cake because it's one of the highest yielding players across our space. And our space really isn't known for yield plays. They're really growth stocks. So it's nice to have that kind of added advantage. Switching gears now, we also see opportunity in a $9 billion market cap software, I'll say driven medical device company, ResMed. The ticker is RMD on that. Really offering what I call an end-to-end digital solution and cloud connectivity really to drive its current product uptake. Now, why are we buying the stock here? It's kind of hitting all-time highs. First, we really like it's ticking all the boxes here for us. It's really focusing on improving clinical outcomes, and that's what we all want. We want better patient care. Really driving efficiencies for its consumers or its customers, which are really the distributors in this channel. It has to sell through those. It doesn't go direct to the consumers. Through the distributors, as I said. And it's also lowering the healthcare costs for the government and the insurance payers. And these are the gatekeepers in this space. And if you can address their concerns, you're winning the race. So I have a tick, tick, tick in all those boxes, which is good to see. Second thing I'd focus on is the large and growing markets in this space. It is a multi-billion-dollar market in the sleep respiratory space. An estimated 1 in 4 people in the developed world have what's called obstructive sleep apnea. This is a sleep disorder where you actually suffocate during the night. You fall asleep and your body, you stop breathing during the night, and your body obviously wakes you up to start breathing again. And you go through that cycle repetitively all through the night. It's a major problem, leads to major chronic diseases. Anyway, ResMed has one of the key products to address that ailment. The third thing I'll point out that people tend to forget, obviously, ResMed is an international company. Really is a key beneficiary from the falling Aussie dollar. 95% of its revenue is derived offshore, and it has 80% of its cost is denominated in AUD. So you can see the falling Aussie dollar is actually a net positive. Like I said, across my space, it's the highest beneficiary of that falling dollar. And last, I would say the digital offering, it is actually having its current portfolio is really kicking some goals. It has over 10 million cloud-connected devices. It has over 11 million patient accounts in its management software system to date. That's over about a 3-year period. That's actually a really strong growth there. That's really leading into increasing margin expansion because this is high margin business and increased profitability. Now we're forecasting double-digit growth for the next 3 years. On the operating line, we have operating margins up 3 points over that same period. Now, looking at the trading where it is, as I said, it's hitting all-time highs here. It's trading at 33 times forward earnings. Not cheap by any stretch of the imagination. And we have upcoming quarterly results, which are volatile at the best of times. But I would say it's a really historic valuation, really fails to capture what this company is growing into. As I said, more of a digital platform play with a high SaaS-based revenue margin uplift model, which is not really reflective, I said, in the current, historical multiples.
Good segue into Volpara, I guess, with the SaaS business. They basically use their artificial intelligence imaging algorithms to assist with the early detection of breast cancer. So there's two things you need to know about Volpara coming up in the short term. Firstly, we're coming into the seasonally strong part of the year for them. So the next 2 quarters are seasonally strong. So at the end of January, we're expecting a strong cash flow report coming through. Now, Derek was recently in Chicago at a major radiology conference talking with Volpara, a number of their customers, and certainly the feedback from that conference was very positive. So we do expect a strong quarter. They have guidance sitting out in the marketplace of annual recurring revenue of just over $17 million. We believe they'll comfortably achieve that, and they're looking to capture around 27% of the mammogram images in the US. Again, that's a target they've set, and we think they'll comfortably achieve that. The next thing that's pending for the industry is an FDA ruling whereby it will be made a federal law that every woman who undertakes a mammogram must be told of her best breast density and what the implications of that are. That will be a positive tailwind for the sector. That FDA ruling can come at any time. In broader news across the sector, we did see an article earlier this week from Google Health in the Nature magazine where they've compared using artificial intelligence to try and determine the accuracy for breast cancer screening, just seeing whether that was better than the expert physicians. And what they came up with was that using artificial intelligence, it was more effective. However, the article did go on to say that more clinical testing will be required before it can be implemented into the market. So that was Google Health. If we then flip across to Volpara, we know that what they have an arrangement with a company called Point Medical, which is doing exactly that. So basically using artificial intelligence to try and determine where the tumour might be sitting on the image and direct the radiologist to that. That product that they are already selling has FDA approval for 2D imaging, and they're pending a 3D image approval. So the question is, does Google Health go it alone, or would they look to partner with someone like Volpara? Given that Volpara already has the technology in place, it has all the clinical data. My guess is that they would probably look to do some sort of partnership in the future with Google Health. That would be an obvious thing. So in terms of Volpara, very happy to have it in our best buy list. It is a speculative company. It's not going to be profitable for a couple of years. It's well capitalised at the moment with plenty of cash on the balance sheet, but happy to have it across clients' speculative portfolio. The other imaging stock we have in the best ideas list is Pro Medicus. It's been very volatile. It's one of these high P stocks that whips around a fair bit. Again, just a quick sort of recap on what they do. They've got software that is used in the radiology departments. It's mainly in the US hospitals. The software enables images to be viewed, manipulated, moved across to other workstations, other countries, other radiologists, images to be stored. Pro Medicus has been very successful in securing a number of tier 1 hospitals in the US, like the Mayo Clinic and Duke Hospital. So it's very high quality technology. Just a quick summary of what the market looks like. There's about 400 million x-rays done in the US each year. Pro Medicus think they're reading about 4% of them, and they get paid per screen, so around $2 a screen. The fundamentals of Pro Medicus look really interesting. So they have an EBIT margin of around 50%, and that is growing. They have a return on equity of 40%, that's growing. And we're forecasting, and consensus of forecasting EPS growth of around about 30% for the next couple of years. But it is one of these high PE names, and it has been very volatile. I was talking to one of the advisors yesterday, and that volatility really made it difficult for her to put into clients' portfolios. However, if you take a 2 or 3 year view, this company will certainly grow to those earnings. So happy to keep Pro Medicus on our best buys list. and we've got a price target just sitting under the $33 mark.